Hey everybody, Patrick Jackson with Mann Mortgage with this week's weekly market update. Today is Thursday, June 9th. It's about 2 p.m. on the West Coast. So that means all the markets are closed for the day. And it looks like the Dow had an awful day, down over 600 points on inflation and fears and oil prices, which are obviously connected. Mortgage bond securities and U.S. Treasuries, which affect mortgage rates, both have had a bad day as well. Unfortunately, they've also had a bad week since I last spoke to you guys. Last week, the average 30-year conventional rate, according to that survey of lenders, was at about 5.43%. And then this week, it's at 5.55%. So almost about an eighth of a point up in the last week, which has gone, it's gone up, which is not good news for interest rates. A lot of people think we're about the cap we're going to be at, maybe not too much higher. Depending on how the next couple months go and inflation numbers and stuff like that. But currently, we're about a quarter of a point higher than we were 2 weeks ago and about an eighth of a point higher than we were last week. And that also is including, I think that survey also is showing about a half a point discount, which is basically the lender charging you to get to that rate. So overall, not the best time right now to get a loan, but also not better than tomorrow if they keep going up. So today we got initial jobless claims for the last. It's a report that comes out which basically covers people first applying for unemployment. So not people that have already been on unemployment, but people, hey, I'm gonna apply now. Generally, people that just got laid off. So that number jumped about 27K to 229,000. And for the month, and it's also about 27K or 210,000 was expectation, so above expectation. So that's something to keep an eye on. Like we've talked about before, once we see that employment rate spike, that really will be the last nail in the coffin in the whole, are we going into a recession or not? A lot of experts in my field feel like that's inevitable. We're already heading that direction. But any naysayers, any doubters, really if we start seeing that unemployment rate spike, that will be, like I said, the last nail in the coffin. So this week, we got 2 different surveys that I want to share with you guys. So let me share my screen here. All right, so the first one is the Zillow Pulseonomics, a Q2 home price expectation survey. So I know how a lot of us feel about Zillow, but it's an interesting numbers to look at. This is something they send out to about 100 to 150 economists every quarter, and this one, it looks like about 114 of the top U.S. economists responded to. So based on those 114 folks, experts in this situation supposedly, they believe over the next 5 years, the average per year of appreciation will be about 4.8%. And then the cumulative over those next 5 years would be about 26.40%. So not 20% a year like we've been seeing, but again, kind of with historical averages around that 4 to 5 range. So 26.4, if you do the math out, if you bought a $500,000 house, 26.4% of $500,000 is about $132,000, I believe, if my math is correct. And so basically that your house would go up to $632,000. So that is a good investment. Regardless where rates are right now, regardless what's going on in the economy, that's if you bought a house now and it's going to be worth $132,000, a 26% more 5 years from now, that's something you should try to do. The other thing they looked at was the outlook to housing. So this is interesting because you see the upside 14%. So basically 14% think that there's a risk of things getting more expensive. 29% think things are kind of balanced. And then 56% think there's a downside to it. And so that kind of comes across a little negative, but really what they're doing there is they're not saying, hey, do you think this is going to happen? They say, what do you think the biggest risk, what do you think there's a bigger risk to, things going too much more higher or pricing coming down? So the downside, that makes sense that I would agree, probably the biggest risk would be a downside, not a bigger upside. But then you come down here and then are we in a housing bubble? 65% of these guys and ladies said no. So obviously most of them don't think, we're in a housing bubble, we're going into a recession. And then can the Fed achieve a soft landing? So basically what that means is, can the Fed get inflation under control without sending us into a recession? So 71% of the economists said that they don't think that's possible. And I would tend to agree with them. It doesn't look like that's going to happen. They've never been able to do it before, but fingers crossed, maybe they're able to do that. Maybe they're able to get inflation under control, keep the economy from collapsing and going to recession, and everybody's happy and it works out for best case scenario. So we'll see. And then the last one, have we reached peak 8.5% CPI inflation? So 41% yes, 59% no. So 59% of people think we're still going to see a little bit more increase in inflation. Hopefully the Fed, their next two raises in June and July, they're meeting this month, and in July when they raise their Fed rates, hopefully that gets that under control, and by that point we see peak inflation. But most of the top economists don't believe we've gotten there yet, and we still have a little bit of room to go. Today, I know the European banks, they announced they're going to start doing their raise. Their inflation is almost just as high as ours. They're getting a little bit slower start on it, and recessions tend to group together. So got to keep an eye on that stuff over Europe too, because it'll definitely still have an effect on us. The next one I wanted to share with you guys was, get myself out of the way here. So MBS Highway, which is an expert in our field, they're in the real estate field, in the mortgage bond market, really who a lot of us use to analyze this kind of info. They started doing their own housing market index. So they surveyed over 2,000 lenders and real estate agents in our fields, and asked them how they felt about their current area in the markets. So as you can see here in the Pacific Northwest, active to very active still at 95%. I think that's the strongest, and tied with the Southeast. So things are still very competitive. Moderate to significant in the pricing pressure. So, nationally, 91%, 79%. California, we're 90, 70. So really strong. So mostly in the Midwest is a little slower, it looks like, but really strong, still very active, where pricing pressure may be a little bit lower, meaning, pricing continuing to increase. So it looks like maybe Mid-Atlantic, there's still quite a bit of price pressure, but here in the West Coast, it looks like that part is slowed down, our price increases, but our the activity, the trying to find something, the lack of supply, is still having a big effect. So really, what that's really going to show is that the lack of supply and the increase in demand over supply is leading to continuing appreciation. So there's not enough houses. People still want houses. So houses are still going to go up price-wise. So again, very interesting. The 2,000 of us, I personally took part of this. So yeah, it's interesting. They're going to do this monthly. So it'll be interesting to kind of track across the nation how people in our field are feeling about this kind of stuff. So so that was about all I wanted to share with you guys this week. Besides that, I hope you guys have a wonderful week ahead. If anybody ever needs anything, as always, please don't hesitate to reach out. Hope you guys have a great day. Thanks a lot.